opportunities.
And you're still getting a pretty good low interest rate by doing the refinance?
4.5% of what it is today. Yeah.
Okay. So you get a good low interest rate. Obviously, it's there's a government aspect to it as well. Can you tell us a little bit about the protections in place for people that are doing this?
Sure. A lot of times people think of reverse mortgages. I grew up in Cincinnati, Ohio, after we left Kentucky. And the theme park, every theme park has spooky land in that. I'm sure you know where spooky land was. That's where the haunted house and Mama said last little girl went in there and never came back. And that's where people put reverse mortgages. They're in spooky land in the financial theme park. And we're saying they're not spooky land. Let's bring these over to the Ferris wheel and the teacups because it's just a mortgage. And so in 1961, the first reverse mortgage came along. 1988, the federally insured reverse mortgage came along. And I just did a webinar with the American College called the three-legged stool of government-sponsored retirement. And most people don't realize that, but the federal government supports and undergirds with their full faith and confidence 3 programs. Social Security, no one was too worried about that, well, maybe a little bit. Medicare, and the home equity conversion mortgage. See, reverse mortgages are part and parcel with our United States government. Ronald Reagan signed it into law. I didn't like Reagan. Okay, well, Clinton re-signed it. I didn't like Clinton. Well, Bush re-signed it. I didn't like Bush. Well, Obama did it. I didn't like Obama. Well, Trump did. Take your president. Pick your president. They all reestablished the program because it's important to retirement in America. And that's why it was developed. Retirement was lasting longer. Boomers hadn't saved enough.
Right.
And there was an asset that they were sitting on that could be used. And if we could do it without having a mandatory monthly mortgage payment, the opportunities to do planning would be greatly expanded.
Yeah, and so let's talk about the worst case scenario now that it's federally insured. Obviously, if the home's worth more at the end of the mortgage, you can liquidate the home and you can get the proceeds. But if the home is worth less than the mortgage, what actually happens in that scenario?
Sure, because the program is actuarially sound and is based off the age of the youngest borrower. It looks at, hey, if homes appreciated 3-4% and you live to 100, you're going to owe this much and the house is going to be worth this much, and it's a perfect match. But it's not a perfect world. We sometimes you live to 100 and we thought you owe us 500,000 and your house would be worth $1 million 30 years later, but it's not. You owe me 500 and the house is worth 400. So now you owe me more than the home is worth. But all reverse mortgages are non-recourse loans, which means the only recourse the lender has are the net proceeds from the sale of the property. And so FHA, if it's a federal loan, makes up the difference. If it's a jumbo reverse mortgage, up to $9 million home values today, the lender is contractually obligated. So all reverse mortgages carry that protection.
Mm-hmm. So you have to be careful to make sure that you follow certain procedures, though, so you obviously can't get kicked out of the house. And you mentioned there's 4 things that you have to do that are required. Can you tell us?
Sure. I'm sure most of your listeners, if you say, hey, have you ever seen a negative story about reverse mortgages? They'll tell you one. Sure.
Right.
And or just go the next barbecue you go to, just mention reverse mortgages. There'll be several folk. But there are 4 requirements of the reverse mortgage. You got to live in the property. At least one of the borrowers has to live in the property. Take care of it. Can't let a tree fall through and not fix it. Pay your property taxes and keep homeowners insurance in force on the property. Now, most people understand who are homeowners. Those are 4 very reasonable things that you've been doing. But there was a season where 10% of reverse mortgage borrowers in the country, that's a huge number, were not paying their taxes and insurance. And so I don't know I'm in Philadelphia, and I've been to Dallas, I've been a lot of places, and typically, if you don't pay your taxes and insurance, the municipality is going to take action. But before they take action, they'll notify Chase, City, Bank of America, whoever the lender is, we're coming, you better get there before us. And that's how an action of foreclosure ensues. So a lot of the stories, I'd say most of the stories, the majority, were because people didn't pay their taxes and insurance. There are a few stories where there are some bad actors in the reverse mortgage space. I would confidently say they have been radically weeded out since 2016, because there was an overhaul of the program that started 2013, 15, 17, 18. So the Reverse Mortgage Stabilization Act weeded out a lot of the bad. And now we've got really a functionally new program, and it's very solid. Mark, it's not for everybody. Even when I work with advisors, and that's what I do. I do case design and consultation. And I say to advisors, Don, do you think this is a solution for all of the clients? Absolutely not.
Right.
No. I said, it's not the conclusion of the matter, but it is a worthwhile conversation to have. Because I don't know, maybe this is a little strong. Maybe this is, I have a dream or I've been to the mountaintop right here. But how could you ignore a person's largest asset when developing retirement income plans? How could you even do that?
Right.
I don't know how that's possible.
And
Well, I do know. I do know. And fairly, it's like the pediatrician, Mark, who doesn't read the journal of pediatric medicine because they're treating kids. Advisors don't have time to look into reverse mortgages, so they can only get sound bites. And the beauty of a program like this and resources that we have behind me and others is that you don't have to. You can take a moment and be educated and get these, and it does a lot more. 42. There are 42 strategies encompassed here. All right, let me stop.
All right. Well, let me kind of conclude this by saying the key to this is obviously you need an expert to do it, so you're getting the right kind of reverse mortgage that's suitable for the client when you're offering to them. And you need to continue to follow up with them, especially so they pay their property taxes and their insurance, right? Because those are the key things that have gotten people in trouble. So as long as you're a financial advisor out there and you're aware of those aspects, you shouldn't be afraid to at least learn and educate yourself more about this. Obviously, that fourth leg of the stool in terms of the assets that people have.
And not a single person has ever showed up in the newspaper who had a financial advisor working with them. Not a single. And I get all the stories that come out that people say, "Oh, look at this. This is bad." And I said, "Not that. That person did not have a financial advisor working with them." So we don't see that when folk are working with experts. And by experts, I mean financial advisors and insurance experts.
Right. Well, thanks for joining us today. I'm sure we're going to have you on future episodes. You got so many stories to share, and we do want to kind of raise awareness about reverse mortgages and how to use them the right way. So thanks so much for your time.
Thanks, Marc Glickman. I appreciate you having me.